This metal is about to break something much bigger than most people realize. Every solar panel installed on a rooftop, every electric vehicle rolling off the production line, every 5G tower being built around the world, they all depend on one critical material: silver. And we are not running out in 50 years, not in 10 years. We are running out right now. What most people do not understand is that this is not just another shortage story. This is not about prices rising slowly or supply chains adjusting. This is about a structural breakdown between demand and supply. And once that breakdown reaches a certain point, markets do not correct gently. They panic. In the next few minutes, I am going to walk you through a 4-stage pattern that has appeared in every major commodity crisis throughout history. Oil in the 1970s, wheat during the Irish famine, palladium in the early 2000s. Different centuries, different systems, same mechanism. And I am going to show you, using public data that you can verify yourself, that silver has already entered stage 3 of that pattern. Once stage 3 begins, the outcome is no longer uncertain. It becomes mathematical. Governments can debate, markets can delay, analysts can argue, but physics and geology do not negotiate. This is not a prediction about what might happen someday. This is an explanation of what is already unfolding. And once you see the numbers, once you understand how fast industrial demand is accelerating and how little silver is actually available, you will understand why this situation is fundamentally different from every shortage you have heard about before. Because when exploding industrial demand collides with a monetary metal inside a debt-based financial system, you do not get a smooth adjustment. You get a shock, and that shock always starts quietly.
Let's start with the numbers. Not opinions, not forecasts, actual data. Global silver inventories on major exchanges are down more than 60% in just 4 years. That alone should alarm policymakers. But it gets worse. In 2020, the entire solar industry consumed roughly 85 million ounces of silver. By 2026, that number is projected to reach 200 million ounces every single year. That is more than double in less than a decade. And this is not speculation. These projections come from energy agencies, industry disclosures, and government mandates. Solar is not a trend anymore. It is policy, subsidized, mandated, legally enforced across Europe, China, and the United States. Now here is the part most people miss. Silver demand is not growing at the margins. It is exploding. Industrial consumption is doubling while global supply is staying flat or declining. Mining output has not kept up. In fact, global silver production peaked years ago. And unlike oil or copper, you cannot just decide to mine more silver. About 70% of silver is produced as a byproduct of zinc, lead, and copper mining. That means silver supply does not respond to silver prices. It responds to base metal economics. And those economics are volatile, capital-intensive, and slow. New mines take 7 to 10 years to bring online. Geology does not care about demand curves. So when demand doubles and supply cannot respond, there is only one outcome. The system absorbs stress until it cannot anymore. And that is exactly what we are seeing now. This is not a future problem. This is a present imbalance that is widening every single quarter. And when markets finally recognize that this gap cannot be closed, they do not reprice slowly. They reprice violently.
Now here is where silver becomes dangerous to misunderstand. Silver is not like oil. It is not like copper. It is not like lithium. Silver is the only commodity on Earth that plays 2 roles at the same time. It is money, and it is a critical industrial material. Gold is money, but it is not consumed. Oil is consumed, but it is not money. Silver is both, and that changes everything. Every smartphone contains silver. Every solar panel uses silver paste. Electric vehicles use roughly twice as much silver as traditional combustion cars. Medical equipment relies on silver for its antibacterial properties. Data centers, 5G towers, defense systems, missile guidance, all depend on silver. Remove silver, and modern technology stops functioning. But at the same time, silver has been trusted as money for over 5,000 years. It was in coins. It backed currencies. It stored value long before modern banking existed. That history matters, because when industrial demand collides with monetary demand, price behavior changes completely. Industries cannot stop buying silver. They need it to function. Investors buy silver when currencies weaken and trust erodes. Those two forces do not compete. They reinforce each other. And here is the key problem. Unlike oil, you cannot substitute silver without losing efficiency. Copper oxidizes. Aluminum conducts poorly. Physics sets the limit, not innovation. Recycling does not solve this either. Most electronics contain fractions of a gram of silver. Recovery is expensive, inefficient, and slow. Solar panels last 25 years. Once that silver is installed, it is gone for decades. So silver demand is sticky, supply is rigid, and inventories are shrinking. This is why silver shortages do not resolve smoothly. They snap. And that brings us to the pattern that governs every commodity crisis in history. Every major commodity crisis in history follows the same structure. Different centuries, different resources, different governments. Same machine. It unfolds in 4 stages. Stage 1 is complacency. Supply feels abundant. Prices stay low for years, sometimes decades. Because the resource is cheap, no one invests in new supply. Exploration slows. Infrastructure ages. The system assumes tomorrow will look like yesterday. That illusion holds until demand changes. That brings us to stage 2, demand shock. A new use case emerges. Industrial adoption accelerates. Population grows. Technology scales. But supply cannot respond. Mining takes years. Refining takes years. Permits take years. Geology does not care about forecasts. At this stage, prices rise slowly. Most people dismiss it as temporary. Then comes stage 3. This is the dangerous phase. Stage 3 is recognition. Markets realize the shortage is structural. Inventories begin to drain. Warehouses empty. Delivery times stretch. Paper markets lose control over physical reality. Contracts exist, but metal does not. This is where confidence cracks. And then comes stage 4. Panic. Governments stockpile. Industries hoard. Exports are restricted. The paper market breaks. Trading halts. Rules change. Cash settlement replaces delivery. Prices do not rise gradually. They gap. Because price is no longer about value. It is about availability. And when stage 4 arrives, price becomes irrelevant. Only possession matters. This pattern has never failed. Not once. And silver is now deep inside stage 3. Will investors recognize the pattern in time?
Let me prove this pattern is real using history. Not theory, not opinions. Events that already happened. First, oil. For decades after World War II, oil was cheap and abundant. The entire global economy was built on the assumption that energy would always be available. That was stage 1. Then demand exploded. Europe rebuilt. Suburbs expanded. Car ownership surged. But U.S. oil production peaked in 1970. New supply was years away. That was stage 2. Then came recognition. In 1973, the OPEC embargo did not create the crisis. It revealed it. Oil prices quadrupled in weeks. Gas lines formed. Inflation surged. That was stage 3. Stage 4 followed. By 1980, oil went from $3 to $35 a barrel, a tenfold increase. The economy broke before supply caught up. Next, wheat. In the 1840s, Ireland depended almost entirely on one crop. Cheap, abundant, taken for granted. Stage 1. Then disease destroyed the harvest. Stage 2. Here is the critical lesson. Wheat still existed, but prices rose so violently that people could not afford it. Physical availability did not matter. Purchasing power collapsed. Stage 3 became stage 4. 1 million people died. Markets did not fail because food vanished. They failed because price dislocation destroyed access. Now palladium. Throughout the 1990s, it was ignored. Cheap. Boring. Stage 1. Then emissions regulations changed. Demand surged. Supply could not respond because palladium is a byproduct. Stage 2. By the late 2010s, inventories were gone. Paper markets lost control. Stage 3. Price exploded from $500 to $3,000. Stage 4. Different commodities, different centuries, same machine. And silver is following it step by step.
Now let's apply this exact same pattern to silver. Stage 1 was complacency. For more than 40 years, silver was treated as irrelevant. In inflation-adjusted terms, silver today is cheaper than it was in 1980. Decades of technological progress, exploding global population, massive monetary expansion, and silver went nowhere. Why? Because supply exceeded demand. Governments sold reserves. Mining expanded. No one worried. That was stage 1. Stage 2 began quietly. A new demand driver emerged: solar energy, electric vehicles, 5G infrastructure, medical technology. Every one of these requires silver. And unlike software, silver cannot scale instantly. Mining takes years, often decades. Worse, 70% of silver is mined as a byproduct of zinc, copper, and lead. You cannot simply decide to mine more silver. Supply is structurally inelastic. Demand is not. Now we reach stage 3, recognition of the deficit. This is where we are today. Global mine production has stagnated. Industrial demand keeps rising. Inventories are collapsing. COMEX registered silver has fallen to levels that represent only weeks of global consumption. Physical premiums are rising. Delivery times are extending. Paper claims vastly exceed physical availability. This is not a shortage caused by panic. This is a structural imbalance with no fast solution. Stage 3 is not about headlines. It is about math, and the math is breaking. Stage 4 has not arrived yet. But once industrial demand and investment demand collide openly, price will no longer adjust smoothly. It will dislocate.
Stage 4 is where most people get confused. They think it's about price. It's not. Stage 4 is about availability. This is the moment when the paper market loses authority, when exchanges change rules, when delivery is restricted, when contracts are cash settled against the buyer's will. This has happened before. Oil in the 1970s, palladium in the 2000s, silver in 1980. Every time, the same outcome. The price explodes, then disappears as a signal. Because at that point, no one is asking, how much does it cost? They're asking, can I get it at all? When stage 4 hits, industrial buyers panic. Governments secure supply. Investors rush to convert paper into physical. But the physical isn't there. That's when premiums detach. Spot prices become meaningless. A screen might say 60. Dealers ask 80, 90, 100. And eventually, there is no quote, just a waiting list. The people holding physical silver are no longer speculating. They're insulated. Everyone else learns the difference between owning something and owning a promise. This is why stage 4 moves fast. Because once confidence breaks, there is no mechanism to slow it down. Mining cannot respond. Recycling cannot respond. Policy cannot print metal. Physics wins. Silver is not collapsing the system. It's exposing it. And when that exposure happens, the window doesn't close gradually. It slams shut.